Happy February. This is StackSource's January review. So we're looking at data and trends in the commercial real estate capital markets through the end of January 2024. I'm Tim Milazzo, StackSource CEO. I am joined by my friend and colleague, Huber Bongelin, Director of Capital Markets on the West Coast. How are you doing, Huber?
Doing well. Excited to be here. First month of the year. Welcome, everyone.
All right. So we're going to jump right into some news and then some data. So first off, everybody's talking about the Federal Reserve, which seems like that has been a trend through the last year or so. In 2023, as the Fed has been fighting inflation with rate moves and looking at economic signals. We do have some remarks outside of an FOMC meeting from Fed Chairman Jerome Powell, talking about the second half of the year being the target zone for rate cuts and taking March rate cuts off the table. So this was a rare public speaking TV show that Powell participated in. And so that's talk of the market as far as the second half of the year being when short-term rates are expected to come down. At the same time, we've seen commercial mortgage spreads tighten. And so that's specifically looking at the securitized market, so CMBS and CLOs and Fannie Mae and Freddie Mac securitizations, whose spreads have tightened against treasuries. At the same time, we've seen inflation staying kind of stubbornly in that 3 to 3.5% range. It has ticked up by 0.3% since the last reading a couple of months ago. So let's go ahead and take a closer look at some rate curves and how they've progressed over time. Huber, what are you seeing in the market indices right now?
Excellent. So for those of you that have tuned in with us in the past, you've seen this chart before. Every single month we update it to show a couple of lines here. One being inflation and the next three being kind of treasury yields, other indices that we track here daily. So this is a long-term graph dating back into January 2021. And I think one of the great things to see is that long-term trend line of inflation starting to march lower. Now, if you look very closely to the last month, you see that there was a slight uptick last month in inflation, but it's nice to see that the long-term trend line is lower. It also appears that rates are starting to stabilize. So that green line being inflation and the other lines, maybe the blue and the gray line, those being rates that we're tracking here. So it's nice to see that those are starting to stabilize, starting to top out versus the big march up in 2022, because that stabilization really helps to build confidence in our commercial real estate community. And then lastly, of course, even though with rates stabilizing, as Tim just mentioned in the last slide, we will continue to await guidance from the Fed, reading their minutes, listening to them, because as we know, their guidance is very much dependent on new data. So we'll be watching intently, but it is a great sign to see those rates starting to top out and even starting to tick a little bit lower in the previous month.
Yeah, and as rates have risen over the last 18 months, we saw transaction activity stay very low in 2023. And one of those reasons was investors, and specifically equity, not wanting to get into commercial real estate at the wrong basis. And so we see that we've come down considerably since the peak in commercial real estate values a couple of years ago. So this is another long-term chart on the commercial property price index. This is specifically Green Street's, and it tracks pretty closely with some other CPPI indices out there. But we're down to a point where we're going to start to see certain investors get comfortable with the basis and start to transact. And especially as interest rates stabilize and real estate investors see that basis has come down, that can spur some more transaction activity. Speaking of transaction activity, we also have lender expectations according to the Mortgage Bankers Alliance. So this is commercial real estate bankers specifically. And we were looking at this report put out by MBA about when lenders on average expect the market to settle. So we've had an upside down market as far as deals getting done and deals stalling out or getting killed. And that's where we find ourselves here in Q1 of 2024. It is a very unsettled market with that dark red. We see that very unsettled expectation start to go away in the second half of this year for 2024 and start to get replaced by this green settled dark green, very settled for 2025. So lender expectations, for what it's worth, is that we're going to see a lot more neutral to settled commercial real estate market and commercial lending market. So there will be more borrowing and lending activity in the second half of the year, and that is a market consensus. So with that, I'd love to hear from you, Huber. Where are commercial mortgage rates today?
Sure, absolutely. Here's another chart that we are very sensitive to. For those on the call, if you'd like to reference it later on, at the bottom there at viewtostacksource.com, you'll be able to see these being updated in real time. What you see here are interest rate ranges, maybe for the most conservative of deals and the most aggressive of pricing, between the different types of lenders that we have here in our market, ranging from agency lenders, CMBS, regional banks, life insurance, debt funds, and HUD. We are tracking these rates in real time across all of our capital providers to be able to provide to you guys where we are seeing rates trending. So one of the welcome signs that we're seeing is rates for the more aggressive pricing, great deals, low LTV, great sponsors, great properties, trading now in the 5% range again, in the upper fives, albeit, but still in the fives, which is a welcome sign. Because for a long time in 2023 rather, we were seeing rates being in the sixes and even in the sevens when things were especially volatile. So going back to the theme of what I was talking about before with the rates starting to top out, it is very much a welcome sign to see that on a lot of these deals, again, very well priced deals, you're seeing them trade in the fives.
And how about on trends in current underwriting and deal structure? So beyond the rate, what can we expect on lending term sheets today?
For sure, absolutely. So when it comes to the actual lending term sheets, there are a couple of big themes that we're seeing here in the market. One is that leverages are actually starting to tighten as well. So for a lot of our lenders, if they had loan to cost or loan to value limits last year or last quarter of maybe 75 to 80%, we're seeing those to start come back down, that there's being a little bit more conservative when it comes to rates, possibly because we're in a price discovery mode right now. So rates right now, if they were previously in the past months allowing for leverage constraints in the 75% range, now you're starting to see them come down to maybe the 65 to 70% range. That's one key theme that we're seeing. The second one on the opposite side is that DSCR ratios are starting to normalize. So while they may be being more conservative when it comes to their loan sizing on leverage, they're being a little bit more loose, a little bit more aggressive on their DSCR ratios. And what I mean by that is, a lot of times when the rates were volatile, we were seeing lenders quoting term sheets in maybe the 1.25 to 1.35 range of a DSCR constraint requirement. But now you're starting to see that come down, starting to normalize and be in the 1.2 for usually multifamily or industrial deals, and then maybe in the 1.25 for other commercial properties. The third theme that we're seeing is that perm lenders are cautiously optimistic. Everyone's cautiously optimistic for 2024 for deals within their sweet spot. So if there were lenders that had maybe different types of programs, maybe they had a program that was for perm deals as well as unstabilized deals. They had bridge deals there. What we're seeing is they may be getting rid of their bridge program and just focusing on those perm deals where their sweet spot is. So they're tightening up and refocusing the programs that they're offering. And then lastly, the fourth key theme that we're seeing here is that bridge lenders are remaining, they're out there. A lot of deals are being done with bridge lenders, but they're being cautious and focused on their exit underwriting. That's a conversation that myself, a lot of our teammates here at StackTrust are having, where it's, hey, guys, tell us about the exit. Walk us through the exit underwriting. How does it look like? We want to ensure that if our transitional loan here, that's about 6 months to 2 years, that loan, we want to ensure that the underwriting is conservative enough, appropriate enough, that we believe in the takeout, that there will be a lender to either refinance us or this deal will sell for the expectations of the client. So those are 4 key themes that we're seeing in the current market for January.
Excellent. And we'll take a look at the months ahead and our expectations there too, based on our discussion leading up to this. I think we both agreed we're going to see various investors of different types calling the bottom of the market in the next few months. So as we've seen commercial property values as an index fall, and that's been led by office and then multifamily, which got overheated, there's going to be a point where people feel comfortable with the basis and they say, this is the bottom of the market. We only expect it to go up from here in general. And that is going to be a moment that spurs investment activity. Now, you may hear general partners and syndicators saying that all the time, trying to tell their LPs, this is the bottom of the market. It's when LPs and institutions and direct providers of capital and family offices, someone with money in their pocket is saying, this is the bottom of the market. I feel comfortable investing right now. These are the types of people to look out for, along with major institutional sponsors that have their own research teams and are looking closely at the economic data. This is going to be moments to look out for that these investors are calling the bottom of the market. The economic data tension is going to continue. We're not at the 2% inflation target that the Federal Reserve is targeting. There's still debate around the health of the market. We have an inverted yield curve, and we have for a long time. But there's a lot less chatter about a recession right now. I think we're going to start to see some more conflicting economic signals that we're going to try to figure out. Where are we? How healthy are the capital markets, bond market, stock market, all? In the meantime, the securitized market, as those spreads have tightened, there's a comeback because bond buyers seem comfortable buying CMBS and other commercial real estate related bonds at this time. And we certainly expect to see more volume of these types of purchases and therefore more lending volume than we did in a strongly suppressed 2023 from a securitized market standpoint. Huber, where would we be able to meet you in person and talk about some of these trends if I'm someone in the industry?
Sure, absolutely. It's one of our favorite times of the year, one of the marquee conferences, MBA CREF 2024. For those that don't know, I mean, if you're a lender on the call, if you're an equity provider, some type of account, you know about this conference. Please do reach out to us. If you're a borrower on the call that may not be so familiar, we're excited because it's conference season, and at MBA CREF, that's a chance for us as capital markets advisors to meet with our capital providers, both debt and equity providers, thousands of players there. So if you will be going and attending that conference this Sunday through Wednesday of next week, next week, we'll be there. Please do reach out to us. Our contact informations are down there. There'll be 4 of us from the StackSource team meeting, developing relationships with those debt and equity players. So if you find yourself in San Diego, please do reach out to us. We'd love to talk.
Excellent. And contact info on the screen for you and some other colleagues that'll be there. And if you can't find it, hello@stacksource.com is always a great contact email address if you're not sure who to get in touch with. So we'll be taking questions, and we'll be chatting for a few more minutes. But if it's your first time with us, we're StackSource. We're a nationwide team of expert capital advisors. So we're constantly working on commercial real estate debt and equity placements on behalf of third-party capital providers. We have nationwide reach. We provide real estate investment and development deals with competitive financing terms and the right capital stack. And we do that with transparency. Here are your matches, here are your offers, and we never take a fee under the table from a capital provider because we are unabashedly in borrower sponsor favor. So that's StackSource. As we transition to Q&A, if you're watching live, please jump into the comments on LinkedIn, YouTube, wherever you're watching with a comment and ask a question. If you missed us and you're watching a replay, we cannot time travel. You're going to need to email hello@stacksource.com. And as we wait for some comments to come in, Hubert, can you talk a little bit more about, so you talked about leverage being a little bit more constrained, especially versus a year ago when we were headed into 2023. How significant is that? How far is LTV or LTC down on average for commercial mortgage deals today?
Sure, absolutely. So it is significant, something to keep out for when you're sizing your deals. But we're seeing that a lot more deals are being constrained by the DSCR sizing metric. So when it comes to LTC and LTV, as we had spoke about previously, from a year ago, they're about 5 to 10% tighter. So if you were working with a bank or a credit union or your local lender of choice, wherever they were a couple of months ago when it came to their max leverage that they were able to provide, for the most part, we're seeing them tighten that by about 5 to 10%. And the reason for that is, the market is still very much in price discovery mode, with new trades settling and setting the new benchmark for cap rates. So with that price discovery, we're seeing lenders come off the gas when it comes to leverage sizing constraints. And again, as we talked about, for most borrowers, the main concern these days is that DSCR, that debt service coverage constraint. That takeout financing for traditional debt, they're looking very closely at that. So when it comes to leverage, it's changing every day, but that's the main theme that we're seeing here in January.
Excellent. The other point that you brought up was bridge lenders being cautious on their underwriting and especially their exit underwriting. Can you give an example or like an aspect that, hey, a bridge lender is really going to struggle with this or question you on this?
Yeah, exactly. I mean, to get more clarity on that, they're very focused on that take. I think I'm kind of beating a dead horse here, but for anyone that is looking to take over an asset, buy an asset, and there is some type of value add that you need to do in it, whether it's new tenants or negotiating new leases or whatever it may be, that takeout strategy has to be very clear. And to go even further on that, the assumptions on that takeout need to be conservative. So when I say assumptions, some of the key things that lenders are looking for and scrutinizing heavily are your rent growth assumptions, as well as your exit cap rate assumptions. I think for a lot of sponsors on the call, investors on the call, and as well as our lenders and capital providers, it's very clear to see in someone's takeout where they had to lower the exit cap or they had to increase their rent growth assumptions in order for the deal to pencil, in order for it to work, right? So while maybe a couple years ago, right, it wasn't so heavily scrutinized, those are two key assumptions that are being scrutinized very heavily in our sponsors' pro formas. The third, if it is a projection, the third assumption that's being heavily scrutinized is our sponsors' operating expenses. So if you're in the market, it is no secret that costs are going up. And especially one that we're hyper-focused on is insurance costs. Insurance costs seem to be going up heavily across the board. So lenders are also scrutinizing projected operating expenses and comparing those to what the current market is. So to summarize here, some of the three key things when you're thinking of your takeout strategy to be mindful of is rent growth assumptions, making sure they're conservative, exit cap rates, making sure that you can prove them with comparables that have recently traded, hopefully the sooner the better in the past couple of months if possible. And then thirdly, operating expenses, specifically honing in on projected insurance costs, right? But all of your operating expenses, are those markets? And if they're not, if you're saying that you're going to be able to operate them more efficiently, then are you able to show other projects in the area that you own where you are able to operate it at those efficient operating expenses? So you always have to be able to back those up.
Makes sense.
Cool. So, Tim, a couple of questions came in regards to some of the sites that you were discussing. So regarding investors calling the bottom, what indicators are they relying on and how might this impact investment strategies in commercial real estate?
So everybody has the same news in the headlines that impact like the general expectations of the market. More sophisticated investors, they're looking directly at economic data and they're putting that into their model. And so there's a macro and a micro lens that everybody basically has access to some of the same data if they're savvy enough to use it. However, I think with real estate investors calling a bottom of the market specifically, they're also looking at the deal flow that's coming at them. They're looking at the cap rates that are being sent to them and how that compares to their cost of capital. And real estate investors that are underwriting deals every day, whether or not they're making offers or transacting on all of those offers that they're making, I think that they're in a unique position if they're underwriting a lot of deals to see cap rates coming in, what brokers are asking for, what brokers are saying, and seeing deals getting done. And so we're going to see different types of investors call the bottom at different times. And a lot of it is going to be based on what are they seeing come to their desk? And does it finally look like a good buy opportunity if they've been one of those investors that's been more cautious in the last few quarters. And so I think investors that are actively underwriting more than just looking at the news or looking at the economic data are in that great position to say, hey, this is finally a good buying opportunity. And what sellers are asking for is in the realm of what I can really offer, and it's close enough that I'd want to get going and make some bids.
Absolutely. And I think one more had just come in here, Tim. Are there specific sectors within commercial real estate that are experiencing more significant changes in underwriting criteria compared to others?
Yes. The chief of those is office, which is upside down from a value perspective, because asking for a loan from a bank on an office property a couple of years ago is no longer the way that you can present and successfully finance an office property today. Truthfully, the devil's in the details with office and some of these product types that have big chunky rent rolls. So think about a major office building. You might have a major tenant that occupies half the building, and then some smaller tenants that occupy the other half. You're going to scrutinize the heck out of an individual lease and all the individual leases on a rent roll today. So you see what would have been considered a strong rent roll a couple of years ago, and all of a sudden, due to the macro work from home trend, due to the capital markets environment, because companies in general are less likely to renew and upgrade their space versus downgrade the amount of square feet they need, all of a sudden you're looking at something that would have been a good yield on paper and a strong rent roll a couple of years ago, no longer being considered a strong rent roll. And that's just a very fundamentally different way to underwrite an office property when the revenue is coming from what you would have considered like, hey, this is a credit tenant. This is a very strong company. They've signed a 5-year lease with me. What more do you want? Well, we actually want to know, are people actually coming in and occupying all that space? Or is this a flight risk at the end of that 5-year term because they're not going to renew the same space? So underwriting is fundamentally different for office. And then I'll just mention multifamily too. Multifamily's been hit hard on the value side, but it had gone up so much on the value side in the last few years that we're still, I think, 30% above like last cycle's CPPI on the multifamily side. Now, office is below 100% index on the CPPI. We're still high on the multifamily, but rent underwriting again has changed. You don't just assume up and to the right on residential leases, and you don't assume like a flatlined or 2% growth in operating expenses. You assume that insurance and taxes are going up more significantly than that. So both of those asset types, the fundamental underwriting has changed, and you can't ask for a loan with a year ago's pro forma. So it looks like we're at the bottom of the queue for questions, Huber. Are you opposed to anybody buying you a drink at MBA in San Diego next week and asking you some questions live?
Not opposed at all. We welcome it. So again, myself as well as 3 other of our teammates will be there. Please do reach out. If not to me, hello@stacksource.com. We'll make sure to get you with someone and would love to hear your thoughts, what you're seeing in the market. That's what we're seeing. You could be seeing something totally different. So absolutely. Let's join. Let's have a drink, have a coffee, get it on the calendar. Would love to see you.
All right. Thanks so much, Huber.
Thanks, everyone. Bye.